I would dare say, Tim, that there are two markets. I don't mean stocks and bonds. I mean two equity markets. There are the companies that probably have real backers because their business may recover faster than we expect, as some of the data points have been positive. And then there's those stocks that I referenced like Hertz, which are just people getting in to make a quick buck. What do you make of these markets, if you will?
Well, I think you hit the nail on the head, Brian. There are a few different markets that have been developing. First and foremost, it's been the super mega cap stocks that have held in the most, and that are stocks that retail investors did not sell when they were getting rid of those companies in the spring that they felt had existential risk. So you've seen the Nasdaq 100 not just break to positive, break to all-time highs, and you've seen the S&P 500 begin to do that as well, mostly because it's the biggest companies that are driving those indices. The small cap market, the mid cap market, and international stocks have not participated. And you've seen over the past few weeks where those companies most affected, even companies in bankruptcy, are starting to get a bid as the market broadens out a bit.
I mean, yeah, Hertz and Whiting, I don't want to be a broken record. Petroleum, they doubled yesterday. They're in bankruptcy. The equities could have zero value, and they're trading on Hertz's case higher than pre-bankruptcy. As my friend and colleague Jim Cramer might say, there's a stock market and there's a market of stocks. Let's move past that. Let's talk about the stock market, the major averages here. How much of this is Fed fueled? How much of this is the reopen or leave your home trade? How much of this is simply, you know what, bonds are going to give us exactly squat, for lack of a better term, and there is no alternative? Or is it a collection of all three things, Tim?
Well, I think it's a collection of all three things, and I think that's what put the market low back in March, is when the Fed stepped in and basically said that they were going to backstop the liquidity in the fixed income market. That sell-off was largely driven by liquidity in the marketplace, and it probably went too far. As we kind of talked about earlier, some of the largest companies stayed pretty, solid during that period of time, whether it's the technology companies or the Walmarts of the world. They didn't have the same downdraft. And now as we come out of this and people start to think that it is not as bad as they thought, it's certainly not as bad across aerospace as they thought. Companies like Boeing were beginning to show signs of existential risk, which is something we hadn't seen since the financial crisis. So Boeing is still down 50% from its all-time high. So even though these companies are appreciating, they are still not exactly where they were before all this started.
Yeah, the average gain of an airline stock this month, and I mean 6 trading days, is 63%. That's the average of all the major airline equities. Boeing, 400 to 95, back to 230. Are you a Boeing buyer? Are you a Boeing believer?
Well, we've owned Boeing for a number of years, and so we've been holding on to it. Certainly before the pandemic, Boeing was really a 737 MAX issue. The rest of the aircraft programs were on schedule and delivering airplanes. So before this became a global crisis, it was really just about the MAX, which accounts for about 30% of Boeing's profitability. So if just the 737 MAX went away, you could see a 30 to 35% risk in Boeing. Now, the global aerospace cycle was put into question, as was their entire supply chain. So that move to 95 wasn't just based on Boeing. It was based on a concern that Spirit AeroSystems, GE, all the people that make the things that go into these planes were also going to go out of business, including the airlines. So we're past that now. All right, so Boeing's got to find its equilibrium.